Greetings everyone. Today I Sidhav Gupta, Bachelor of Management Studies, 6th semester, Keshav Maha Vidyalaya, University of Delhi is here to present you a presentation on the IPO process in the subject Financial Institution and Market DSC Finance BMS 6th semester. First, let's go into introduction. What is an IPO? IPO, that is initial public offering, refers to the process of offering shares of a private corporation to a public in a new stock issuance. Public share issuance allows a company to raise capital from public investors. Transition from a private to public company can be an important time for private investors to fully realize gains from their investment, as it typically includes share premiums for current private investors. That is, IPO refers to the time when a private company issues its shares to the public for the first time to raise capital that can be used for the growth of the company. The term go public is a very important term in a finance and a very important phase for a company. It refers to when a business offers securities for sale to general public to obtain a listing on a stock exchange. That is, a company goes public through the process of an IPO for the first time. Prior to an IPO, a company is considered to be private with small number of shareholders, limited to the investors like angel investors, venture capitalists, and high net worth individuals, and early investors such as founders of the company. After an IPO, the shares of the company are generally available to the public through a recognized stock exchange. An initial public offering is a route to raise funds from market. It is the first sale of a share of the company to public, institutional investors and high net worth individuals. After share sale, company is no longer private held. It becomes a public listed company with shares traded on stock exchange. There are a number of alternatives to an IPO for raising funds to the company. Company can raise funds through debt in form of debt from the market, from a loan from the bank, and also from private entity like angel investors and venture capitalists. Approaching private equity is also an option that companies frequently consider. Advantages of company having listed stock. We will be discussing about IPO process, but it is also important to understand why a company wants to go listed. What are its advantages? In addition to prestige a company gets when their stock is listed on a stock exchange, other advantages of the company going public are as follows. Being able to raise additional funds to issuance of more stock. By issuing more stock, company is able to increase its value and also able to raise funds that can be used for the growth of the company. Companies can offer securities in acquisition of other companies. Stock and stock option programs can be offered to potential employees, making the company attractive to top talent and also increasing the motivation of the employees to work better for the company. Companies have additional leverage when obtaining loans from the other financial institutions when it is a listed company in a recognized stock exchange. It also increases the market exposure of a company. Having a company stock listed on the exchange could attract attention of many other large entities like mutual funds, hedge funds, market makers, and institutional traders. Indirect advertising. Filing and registration fee for most major exchanges include a form of complimentary advertising, as we will see later. These form of advertising provides company a recognition in the market. Brand equity. Having listing on a stock exchange also provides company with a brand equity. What What makes a company eligible for IPO? Sebi has listed some stringent rules which should be complied with before a company can be eligible for an IPO. After all, IPO involves putting IPO involves taking money from the public, and as Sebi is highly concerned about the interest of its investors, it has laid down specific conditions which must be fulfilled before a company is eligible for an IPO. The company should have net tangible assets of at least 3 crore in each of the last 3 years, of which not more than 50% should be held in monetary assets. Only exemption available to 50% monetary asset is that a company must have firm commitments to utilize the excessive amount for the businesses in the future. Total paid up capital shall not be less than 10 crore rupees, and the market capitalization of the company should also be not less than 25 crore rupees. Company must have delivered profits in at least 3 of the last 5 years, subject to the exclusion of extraordinary items such as sale of land or any key portion of the business. It has a minimum net worth of at least 1 crore in each of the last 3 years. The total issue size should not exceed more than 5 times its latest net worth. If the company name has been changed in last 1 year, at least 50% of its revenue of last 1 year should be earned after the name has been changed. There are many other rules and regulations to comply with regarding the management and the revenue of the company, but these are the major ones that should be complied before a company is eligible for an IPO. Terms associated with an IPO. Before learning about the IPO process, these are just some major terms which we should learn before going into detail about the IPO process. Price band and fixed price IPO. A price band is a range of prices at which the stock can be issued for the first time. Fixed price IPO is a fixed price at which the share of the companies are available. Draft red herring prospectus. This is a document that gets circulated to the public after Sebi gives an IPO to green signal. It is also just simply called the prospectus of the company. This document contains the detail of initial share offer and crucial details of the company such as financial information, risk associated, future plans, etc. Undersubscription and oversubscription. An IPO is undersubscribed if bids received are less than the number of shares offered. If the bid received exceeds the number of shares on offer, the IPO is called to be oversubscribed. Green shoe option. This is an option for over allotment included in the underwriting agreement. This allows the issuer to release additional shares in event of oversubscription. Steps involved in an IPO process. The IPO process in India is a lengthy one. One should note that the entire IPO process is regulated by Security Exchange Board of India, that is Sebi. This is to prevent any likelihood of a scam and to protect the interests of the investor. The steps involved in the IPO process are: first, hire an investment bank; second, register with the Security Exchange Council of the country, that is Sebi; third, draft the red hiring document, that is the prospectus; fourth, go on a roadshow; fifth, IPO pricing; sixth, availability to the public; seventh, going through with the IPO. Now we will see each step in detail. The first step for IPO process is hiring of an investment banker or the lead manager. A company seeks guidance from a team of underwriters, the work which is done by investment banks, to start the process of an IPO. More often than not, they take services from more than one bank. When services of more than one bank are taken, the bank leading the charge is called the lead bank or lead manager. The team hired will then study the company's current financial situation, work of their assets and liabilities, plan to cater the financial needs, the need of raising the funds, and many other things. An underwriting agreement will be signed between the company and the investment banker, which will have all the details of the deal and the amount that will be raised, securities that will be issued. Though the underwriters assured on the capital they will raise, they won't make promises. The mandate of investment bank is to find the best valuation of the company and get investors to buy the IPO. To ensure the success of IPOs, investment banks are required to underwrite the issue either themselves or through a third party for a fees. That is, to provide a security that their issue will be subscribed to an extent. For regular IPOs, no single investment bank would like to assume full risk, and thus usually a syndicate which indicates other merchant bank is made. The syndicate of bank is generally led by a bank that is a lead manager or the lead bank. Second step is registration with Sebi. The company and the underwriters together filed a registration statement which comprises of every fiscal data and business plan of the company. It will also have to declare how the company is going to utilize the funds it will raise from the IPO and about the securities of the public investment. If the registration statement has compliance to the stringent guidelines set by the Sebi, as mentioned before, which ensures that a company has disclosed every detail to the potential investors and has met the eligibility criteria that has been set by the Sebi, it gets the green signal. Else, it is sent back with the comments. The company should then work on comment and file for the registration again. Third, and one of the most critical steps for the IPO process is draft the red herring document, that is the prospectus. An initial prospectus which contains the probable price estimate per share and other details regarding the IPO is shared with the people who are involved with the IPO. It is called red herring document because the first page of the prospectus contains a warning that states this is not a final prospectus. This phase tests waters for the IPO among the potential investors. When all the three parties, issuing company, investment bank, and underwriters, and in case the investment banker is the underwriter, the two companies agree on the broad counters for the IPO, they need to prepare a draft prospectus and submit the same to the Sebi. The prospectus is a document covering extensive details about the company's business so far, its plan for the future, and a competitive scenario in the industry. The regulator's job is to analyze the prospectus filed by the company, and it may ask a follow-up question to demand more disclosures and more information that should be present in the prospectus. The document should get a firm approval by Sebi before we can proceed with the next steps. After the prospectus gets the approval, the next step is to go on a roadshow. It is not an essential step, but it is necessary for the advertising of the company, advertising the issue of the company, getting to tell people about the issue so that their company can get both recognition and their issue can be a successful one. Now that issue has been approved by the regulator, company management and lead managers travel extensively across the country to market the IPO to potential investors, which are institutional investors. Generally, 50% shares in the main board are reserved for qualified institutional investors, that is mutual funds, hedge funds, etc., and other retail investors and high net individuals are left out with other 50%. The roadshow phase lasts for at least couple of weeks and may take longer if more investors are required to be roped due to size and attractiveness of the issue. The roadshow marks the advertising of the issue and increasing the brand equity of the company. IPO is priced. It is the most important aspect for for the term of an investor. Based on whether the company wants to float a fixed price IPO or book building issue, the process which will be seen further, the price or price band is fixed. A fixed price IPO will have a fixed price in order for a document, and a book building will have a range of price. When the company drafts a prospectus, it is not required to disclose how the issue will be priced and when it will be launched. Once the process of prospectus and road show is completed, the pricing process starts. The IPO's price band, discount to retail investors, employees, and minimum bid lot size are decided only a couple of days before the IPO. There are two types of issues pricing system: the fixed price IPO and book building IPO. Under a fixed price IPO, a fixed price for each share or lot of share is being announced by the company, and all the allotment will be take place at that fixed price only. For example, if a company ABC Limited issues 10 lakh shares at a face value of 10 rupees each with at a premium of 55, each share will be available to the public at the same price of 65 rupees. A book building issue helps the company discover price of the issue. Under this, a range of price, for example, price rupees 60 to rupees 70 is provided to the investors, and investors can bid at their suitable price. According according to this, um, a reverse pricing system 70, 69, 68 is taken, and a cumulative number of demand at each and cumulative number of demand at each price is taken. The cutoff price at which the demand meets the demands need the number of share available is taken as the cutoff price, and all allotment is made at that cutoff price. Step number 6: availability to the public. On a planned day, prospectus and application forms are available to the public online and offline. People can get a form from any designated bank, broker firms, or online brokerage services. Once they fill in the details, they can submit them with a check, or they can submit it online to other facilities like net banking. Sebi has fixed a period availability on IPO to public, which is usually 5 working days. Upon completion of IPO bidding, allotment is the next important step. The responsibility of the phase is with the issue registrar. Even in the case of successful IPO, there are different possibilities, and according the number of shares allotted may be different. Since the stock trading is mandatory in demat form in India, the registrar has to ensure credit of shares in respective demat accounts of the successful bidders. We need to understand the allotment process here. The allotment process is in a oversubscribed to a little bit is taken when one lot of share is allotted to all is allotted to all the number of bidders, and then the number of left share are allotted to the remaining bidders. In case a share is being subscribed on more number of times, like 5 times or 10 times, the allotment is mainly done on a lottery basis. Allotment to the other class of investors such as HNIs and QIBs are generally made on pro rata basis. That is, they will be getting number of shares in proportion of the demand. For example, if a subscription gets oversubscribed 5% of time, each one of them will get 1/5 of the total number of shares they demanded for. Last step for an IPO is going through with the IPO. It's not an initial step but just an extension of the last step. In India, IPO process culminates with a form of listing of the company on the stock exchange in the secondary market. That is, after availability and allotment to the public, the stock gets listed on the stock exchange. Most of the time, the stock opens, and oversubscribed stock opens at a premium price due to the increased demand of the investors who cannot get hold of the stock. Anchor investors are subject to a lock-in period of 30 days from the date of allotment. Lock-in is more stringent for the promoters. According to Sebi regulations, 20% of the stock's fully diluted post-offer equity shares are held by promoters locked for a period of 3 years from the date of the issue. Therefore, we understood many things regarding why an IPO is necessary, what are the why companies go for an IPO, terms associated with it, what are the eligibility conditions for the IPO, and the process which start from hiring an issue manager to draft getting registration from Sebi, drafting and prospectus, roadshow, pricing, allotment, and going public. Therefore, we understand IPO is an important step for a company wherein it goes public, and a process is a long one. Therefore, proper conditions should be met and proper compliance should be made at each and every step so that the process goes smoothly. Thank you.